Imagine handing over the keys to a business you've spent, a decade building. And then, imagine finding out 3 years later that just one missing clause in a 40-page legal document means you are personally on the hook for a £100,000 tax bill.
Yeah, that is a nightmare scenario. And it happens.
It does. And it happens when sellers treat the legal phase of a sale as just, well, a minor administrative box-ticking exercise.
Right, exactly.
I'm actually right in the middle of selling my business at the moment, and if you are listening to this and you've ever been in my shoes, you know the exact feeling. You're staring at this mounting pile of legal bills, you are completely drowning in paperwork, and you're lying awake at night wondering, what is my lawyer actually doing behind the scenes?
And why is it taking so incredibly long, right?
Yes,
Yeah.
exactly. It really feels like you're just paying someone to aggressively shuffle paper around and, I don't know, argue over commas.
It is honestly the most universally shared frustration in M&A. The legal phase often just feels like this impenetrable black box to the seller.
It really does.
You hand over a small fortune, and in return you get, well, stress, delays, and a lot of Latin phrases in your inbox. But what your lawyer is actually doing, if they're the right lawyer, is building a permanent fortress around your financial future.
Which is why we're doing this deep dive today. We are pulling back the curtain on that black box strictly from the seller's perspective.
Exactly. Because this isn't just about transferring ownership. It's the single most critical part of protecting the money you're about to make so that you actually get to keep it.
Right. So we are going to decode the jargon, explain what you're actually paying for, and show you how to manage your lawyer to get the deal done safely and efficiently, hopefully.
Well, let's start with the very first mistake sellers make, because it happens before the process even officially begins.
I have a feeling I know what you're going to say, because my first instinct when I decided to sell was to look at costs.
Naturally.
Right. I thought, well, I already have a trusted high street commercial solicitor. They handle my office leases, my standard supplier contracts. I'll just use them for the sale and save a fortune.
And that right there is what we call a deal killer. Absolute deal killer.
But why, though? If they're a qualified commercial lawyer, why can't they handle a commercial sale?
Because mergers and acquisitions is a highly, highly specialized field. An ordinary commercial solicitor, even a brilliant one, they just don't have the specific transactional awareness required.
So a business sale isn't just a big contract, then?
Oh, not at all. It involves complex tax structures. It involves 2UPE regulations.
2UPE. I've heard that thrown around, but what does it actually mean in practice?
So 2UPE stands for Transfer of Undertakings Protection of Employment.
Okay.
It's an incredibly strict set of UK laws. Basically, it means when a business is sold, the employees automatically transfer to the new owner, and they keep all their current terms, conditions, and continuous service completely intact.
Right, so you can't just mess with their contracts.
Exactly. If a seller tries to, say, clean up the business by firing people right before the sale to look leaner, or if the buyer tries to harmonize contracts on day one, it triggers automatic unfair dismissal claims.
Oh, wow, so the liability is huge.
Massive. And when a general solicitor sees TUPE, where they see complex restrictive covenants, they panic. Their default instinct is to look at all this unfamiliar risk and tell you, this is too risky, don't do it.
Because they don't know where the safe harbors are. They don't know what a normal amount of risk looks like in an M&A deal.
Precisely. The right lawyer gets it done safely. A good M&A lawyer's instinct isn't to kill the deal at the first sign of friction. It's to find creative, commercial solutions to keep the deal alive while keeping you protected.
Okay, but let me push back on this a bit. Because M&A specialists charge a massive premium.
They do.
And frankly, if I agree to a capped or fixed fee package, which everyone says you should try to do,
Right.
doesn't that just incentivize the lawyer to cut corners? To protect their own profit margin once the deal inevitably drags on for months.
It's a fair concern, but you have to remember the golden rule of M&A pay for value, not hours. A true M&A lawyer prices in the standard back and forth.
Yeah.
Plus, a £5,000 premium on legal fees that saves you from a £50,000 liability down the line. That's not a cost. That is an investment.
Yeah, that makes sense when you put it like that.
And a specialist will often offer an abort fee structure.
What's that?
So if the buyer pulls out through no fault of your own, the lawyer caps their fees at a lower percentage of the work done. They share the risk with you. A generalist billing by the hour, well, they'll just keep the meter running until you're bled dry.
Okay, so we bite the bullet, we hire the M&A specialist, we agree on a fee structure, the meter is on. the very first thing they look at is the heads of terms, or the HOTs.
Right, the HITs.
From what I understand, this is basically the initial handshake agreement written down, and it's mostly non-binding. So why does my expensive lawyer need to spend hours analyzing a non-binding document?
Well, because while the document as a whole is non-binding, four crucial elements within it absolutely are legally binding: jurisdiction, fees, confidentiality, and exclusivity. Your lawyer's primary job right at the starting line is to spot the red lines before you commit massive resources to the process.
Give me an example of a red line that I might miss as a seller, but my lawyer would catch.
Let's say you're selling your business for £2 million, but 500,000 of that is deferred consideration.
Meaning the buyer pays it to me over the next couple of years out of future profits.
Exactly. Now, the buyer's initial heads of terms might sneak in a demand for a personal guarantee from you,
A personal guarantee for what?
meaning if they run the business into the ground after you leave and it fails, they want you personally on the hook to forfeit that money or even pay back debts.
Wait, are you serious? I'd be guaranteeing the success of a business I don't even control anymore?
Precisely. And a good M&A lawyer flags that immediately and says, no, we absolutely do not accept personal guarantees. Let's make that clear right now before we spend thousands on due diligence.
That is sneaky.
It is. They also focus heavily on the exclusivity period. The buyer usually demands 3 to 5 months where you cannot shop the business around to anyone else.
Right.
Your lawyer will try to insert a financial penalty so that if the buyer just capriciously breaches the terms or suddenly pulls out, you aren't left entirely out of pocket for the legal fees you've incurred so far.
Okay, so all of that gets ironed out, the heads of terms are signed, and then the real nightmare begins. Because, I mean, I'm living this right now.
The information request.
Yes, the buyer hits you with this massive information request, and your lawyer sets up a data room, which is essentially a highly secure, heavily organized cloud folder.
Yep.
And the sheer volume of information they demand, it feels like a digital colonoscopy for your business. My lawyer is currently harassing me for a 5-year-old employment contract for a guy who doesn't even work here anymore. It's agonizing.
It's a painful metaphor, but completely accurate. Sellers constantly clash with their own lawyers at this stage. They think the lawyer's just being unnecessarily pedantic.
Well, yeah, because I'm trying to actually run the business to keep the numbers up, and my legal team is breathing down my neck for minor health and safety records from 2021.
I know. But here is why your lawyer is being relentless. Getting accurate, comprehensive information across to the buyer quickly is the single most important thing you can do to keep the deal alive.
Really?
Yeah.
Speed is that important here.
Absolutely. This data room forms the entire foundation of the buyer's due diligence. If you're slow to upload documents, or if the information is disorganized or incomplete, the buyer's team starts to lose confidence.
They think I'm hiding something.
Exactly. They start wondering, well, if their record keeping is this chaotic, what else is wrong? The momentum dies, the buyer starts dropping their offer price, and remember, the golden rule: time kills deals.
Time kills deals. Yeah, that is the mantra. So, assuming I survive this digital colonoscopy, all these documents are sitting in the data room. The buyer's lawyer is reading through my old contracts. I assume that's what triggers them to actually start drafting the formal sale agreement.
Exactly. And this is a fundamental piece of M&A architecture. It is almost always the buyer's lawyer who drafts the share purchase agreement, or the SPA.
Which drove me absolutely crazy when I received the first draft. I mean, why am I paying my lawyer a premium to let the other side set the rules of the game?
You have to think of it from the buyer's perspective. They are the ones handing over a massive sum of money and taking on all the historical risk of your company.
Fair point.
So standard practice dictates they get to set the initial terms of protection. Your lawyer's job isn't to draft it. Your lawyer's job is to read it, review it, and systematically chop out everything that is commercially unreasonable.
So they're playing defense.
Exactly. Buyer's lawyers will overreach. They always do. Your lawyer is basically acting as a highly paid bouncer, just throwing out the ridiculous clauses.
Let's break down the anatomy of this monster document. When my lawyer is going through the SPA, what are the main sections they're actually fighting over?
Broadly, it breaks down into a few main arenas. First, the financials. And this isn't just stating the purchase price. It's the complex mechanics of how and when you get paid.
Like the deferred consideration we talked about.
Right. If the buyer owes you money over the next 2 years, your lawyer will negotiate trigger events. Say the buyer defaults on a payment, or there's an insolvency event like bailiffs showing up at the business.
Oh, wow.
Yeah, that triggers an immediate, legally enforceable demand for the full outstanding balance.
That makes total sense. You need a mechanism to force their hand. What's the next arena in the SPA?
The restraint of trade clauses. When a buyer acquires your business, they're paying a heavy premium for your goodwill.
Right, the brand reputation, the loyal customers.
Exactly. Goodwill is the fact that your customers keep coming back to you instead of a competitor.
Mm-hmm.
The buyer wants to protect that. So the SPA will include non-compete and non-solicitation clauses.
To stop me from taking my massive payout, walking across the street, setting up an identical business, and poaching all my old staff.
Precisely. And then beyond that, you have endless schedules detailing specific properties, staff, and shareholders.
It's just pages and pages of it.
It is. But a sign of a truly experienced M&A lawyer, especially on smaller or mid-market deals, is that they actively try to keep this document concise. A junior lawyer will let a SPA balloon to 100 pages of irrelevant legalese. A seasoned specialist knows the boundaries and will try to keep it down to 25 or 30 pages.
So you aren't overwhelmed by things that don't even apply to you.
Right. They ensure you aren't buried under warranties that just don't fit the scale of your specific transaction.
Which brings us perfectly to the two words that keep every business owner awake at night: warranties, indemnities.
Ah, yes.
I read these clauses in my draft SPA and I just see landmines waiting to blow up my retirement fund. Let's talk about warranties first, because they sound terrifying. How do I make sure I don't get sued for something that happened 3 years ago?
Well, to disarm those landmines, your lawyer will use arguably the most important document in the entire process, the disclosure letter.
Okay, my lawyer mentioned this. How does the disclosure process actually work in practice?
Your lawyer will literally sit you down in a room or on a very long video call and go through every single warranty in the SPA line by line.
Sounds exhausting.
It is. Let's use a hypothetical. There's a standard warranty that states there is no pending or threatened litigation against the company. But you happen to know that a disgruntled former employee sent an angry email last month threatening to take you to an employment tribunal.
Okay, my immediate instinct as a seller is to say absolutely nothing. If I tell the buyer about an angry ex-employee, they might get spooked and lower the price, or just walk away.
And your lawyer will look you in the eye and tell you that hiding it is the worst thing you could possibly do.
Yeah.
You absolutely must formally disclose it in the disclosure letter.
Why won't it kill the deal?
Rarely. By disclosing it before the SPA is signed, you're effectively putting the buyer on notice. You're legally saying, hey, I am telling you this skeleton is in the closet. You are buying the house fully aware that the skeleton is there. And because you disclosed it, it completely protects you from a future breach of warranty claim regarding that specific issue.
So the disclosure letter is my shield. If I declare the skeleton, they can't turn around and sue me for finding it later.
Precisely. It is your opportunity to lay all your cards on the table safely.
Okay, but let's look at the actual difference between warranties and indemnities. Because to a layman like me, they sound identical. They both just sound like mechanisms where I have to pay money back if something goes wrong.
They are entirely different beasts in the eyes of the law. Let's look at warranties first. Warranties are promises you make about the state of the business. You know, the accounts are accurate, the equipment works, we own the IP.
Right.
But here is the secret, that M&A lawyers know warranties are actually incredibly hard for a buyer to enforce in reality.
Wait, really? Why is that?
Because of the burden of proof. If a buyer wants to sue you for a breach of warranty after the sale, they have to jump through two massive legal hoops. First, they must prove a specific, quantifiable financial loss resulting directly from that breach, say 10,000 pounds, because a piece of heavy machinery was fundamentally broken.
I mean, that sounds hard enough to litigate on its own.
It gets harder. Second, they have to prove that this specific 10,000-pound loss actually reduced the overall value of the shares they bought.
Oh.
Right. A valuer might look at a multi-million-pound acquisition and say, well, yes, the machine was broken, but the business as a whole is overperforming. In the grand scheme of things, you still paid a fair market value for the shares.
And if the valuer says that?
The buyer has no claim. The warranty breach didn't devalue the shares.
So proving a warranty claim is this massive, expensive, uphill battle for the buyer. If warranties are that hard to prove, they're basically just a scarecrow.
A scarecrow, I like that.
Yeah. They're just there to frighten me into being completely honest during the disclosure process rather than acting as a real weapon to claw back money.
Exactly.
But if warranties are the scarecrow, what is an indemnity? Because buyers always ask for those too.
I am absolutely stealing that analogy. If warranties are the scarecrow, Indemnities are a laser-guided missile pointing directly at your wallet.
Okay, explain the missile. How does an indemnity bypass all that burden of proof?
Indemnities are specific, pound-for-pound financial protections negotiated into the contract for known, identified risks. They completely bypass the argument about share value.
Do you mean example?
Let's say during the data room phase, the buyer's accountant spots that you and your co-directors have been running the leases for your personal Ferraris through the company accounts to save on tax.
Whoops. Classic lifestyle business problem.
Exactly. The buyer knows HMRC might eventually come knocking with a massive, punitive tax bill for that little stunt. They will demand a specific indemnity for that exact issue.
And if that happens,
If that tax bill arrives 2 years post-completion, you, the seller, pay it directly, pound for pound. There is no argument about whether it reduced the overall share value. You just write the check.
no wiggle room whatsoever.
None. And the ultimate laser-guided missile is the tax covenant. It appears in almost every single share sale.
Why tax specific?
Because tax is the biggest hidden risk with the steepest penalties. The buyer will demand a blanket indemnity against any pre-completion tax liabilities, and this tax covenant lasts for a very long time.
How long are we talking?
7 years.
7 years. I have to look over my shoulder for an HMRC audit for 7 years after I sell.
Yes. The statutory limitation for HMRC to look back at your records is 6 years. Buyer's lawyers add a 1-year buffer to that, making it 7 years of absolute protection for the buyer.
That is terrifying. Honestly, if I have a vindictive buyer, what stops them from using these clauses to just nickel and dime me with tiny lawsuits for the next 7 years? Like, oh, the office microwave broke. I'm suing you for $100.
And this is exactly where your M&A lawyer earns their fee. To stop a buyer from bringing frivolous claims, your lawyer will negotiate what is called a basket of claims.
How does the basket mechanics actually work?
It establishes strict financial thresholds. First, they negotiate a de minimis limit, meaning no individual claim under, say, 2,000 pounds even counts.
So you can't sue for the broken microwave.
Exactly.
All right.
Second, they establish a threshold limit. The buyer cannot take any legal action unless the total aggregate value of all their valid claims, the basket exceeds, say, 10,000 pounds.
Ah, I see.
It ensures that post-deal litigation is strictly reserved for serious material issues, not minor buyer's remorse.
Okay, that lowers my blood pressure significantly. So, assuming we survive the data room, we fight over the SPA, we disclose all our skeletons, and we lock in the basket of claims, we are at the finish line.
The finish line, yes.
How does this deal actually get signed? I always picture everyone sitting around a giant mahogany boardroom table, aggressively sliding contracts back and forth with expensive fountain pens.
You can completely forget the mahogany boardroom. That is purely for the movies. Today, 95% of deals use simultaneous exchange and completion, and it is entirely digital.
Simultaneous exchange and completion, meaning there's no gap between signing the contract and actually handing over the business?
Exactly. It all happens on the same day. The lawyers hold a final completion call. And they aren't just signing the SPA, they go through a massive checklist of usually 15 to 20 required ancillary documents.
15 to 20. What else is there besides the sale agreement?
Oh, there's resignation letters from the outgoing directors, stock transfer forms to legally move the shares, board minutes approving the transfer, and the immediate company's house filings.
It's a mountain of administrative paperwork.
It is, and it legally effectuates the transfer. Once all of that is digitally signed via DocuSign and verified on the call by both legal teams, the funds are transferred.
Let's talk about those funds, because there is a massive tactical detail here that sellers in the UK need to know, especially regarding business asset disposal relief, or BADR.
Yes, crucial point.
So, BADR allows you to pay just a 10% capital gains tax rate on the first £1 million of the sale. Because of this, sellers love a structure where they leave the cash inside the business, sell the shares, and the buyer uses that company cash to pay a portion of the purchase price.
Right, rather than the seller taking it out as a heavily taxed income dividend right before the sale.
Exactly. It's a brilliant, highly tax-efficient structure, but it creates a terrifying chicken and egg scenario on completion day. Who controls that cash right before the deal is finalized?
Right, because if you formally transfer the shares of the business, but the cash hasn't hit your personal bank account yet, you've just legally handed them your business and your cash.
They could just walk away.
They could. And this is where a nervous seller's lawyer needs to hold their ground and show their teeth. Some buyers' lawyers will suggest sending the cash from the business to their legal account first, and then they will send it to the seller.
That sounds incredibly risky.
It is. Your lawyer should categorically refuse that. They must insist that the funds are transferred directly from the business to your lawyer's client account before the final completion documents are released.
So my lawyer holds the money.
Yes. That way, your legal team maintains total control of the money up to the very last second. You never lose control of the cash before you officially hand over the keys.
That is phenomenal tactical advice. So, looking at this entire complex journey, how do I get the absolute best out of my lawyer? What are the biggest mistakes you see sellers making that cause these deals to derail?
Well, the first one we already covered, choosing a generalist instead of an M&A specialist.
Right.
But the second biggest mistake is working in silos. You have a business broker, you have a tax accountant, and you have a lawyer. Introduce them to each other immediately.
They need to talk to each other.
They need to operate as a single deal team. If your accountant comes up with a brilliant BADR tax structure, but your lawyer doesn't know about it until the SBA is already drafted, you are going to waste thousands of pounds redrafting documents.
Yeah, that makes a lot of sense. What about communication? I feel like I'm constantly drowning in emails.
The worst thing a seller can do is rely on endless, passive-aggressive email chains between legal teams. If there is a sticking point over a specific warranty, do not let your lawyer send 5 emails over 3 days.
So what should I do?
Tell them to pick up the phone. Force a quick 10-minute conference call between you, your lawyer, the buyer, and their lawyer. You will resolve more commercial friction in 10 minutes of speaking than in 3 weeks of emails.
So if I'm summarizing this entire journey, yes, the legal fees hurt. Yes, the data room is an absolute nightmare, and the legal documents are incredibly dense.
Very dense.
But your lawyer isn't just shuffling paper to justify their existence. They're actively building a fortress around your money. They're ensuring that once you sell, you actually get to keep the proceeds without spending the next 7 years looking over your shoulder for an HMRC audit or some frivolous lawsuit.
Exactly.
You need to choose an M&A specialist. You need to be radically transparent with your skeletons during the disclosure process. You need to stay engaged in the process instead of just blindly signing things.
You are paying for certainty, and you're paying for finality.
Yeah.
But since you mentioned not wanting to look over your shoulder, consider this one final scenario that catches so many business owners out.
Oh, no. What is it?
Let's say your business operates out of a leased commercial property, a warehouse, or a high street office. You sell the business, the buyer takes over the lease, you get your money, and you ride off into the sunset.
Sounds like the ultimate dream scenario.
3 years later, the new owner mismanages the company, goes bankrupt, and stops paying rent. Did you know that in many standard UK commercial leases, there is an authorized guarantee agreement clause?
An AGA?
Yes, an AGA.
What?
It legally allows the landlord to bypass the bankrupt company and come directly after you, the previous tenant, for all the unpaid rent.
Are you serious? Even after I sold the business?
Unless your M&A lawyer carefully managed the handover of that property lease, limited your exposure, and secured the correct legal releases from the landlord during the sale process, you could be personally bankrupted by someone else's failure years after you sold the company.
That is, wow.
So the legal paperwork you're paying for today isn't just about selling your past. It is quite literally the only thing protecting your future.